$20,000 tax dilemma. How to eliminate $20,000 of annual IRS tax liability. This slide deck is about a recent encounter with the owner of a dental practice in Lakewood, California. Her annual tax liability is $20,000. She is in her early 30s, earning approximately $100,000 to $150,000 per year. Her practice has 2 full-time employees, herself and 1 part-timer. Currently, the practice does not offer any benefits to its employees, and the company is incorporated as an S corporation. This is what we could have done for her had she taken the time to listen to us. Our recommendations for this situation are as follows. Set up a high deductible health insurance plan. Create a health savings account. Start a safe harbor 401k plan. Purchase professional overhead expense insurance. And purchase a disability insurance policy through an executive bonus plan. Since each of the employees, including the owner, are under the age of 35 and appear to have no chronic illnesses, the owner should establish a high deductible health insurance plan versus an HMO or an expensive one-size-fits-all P.O.E plan. So, by starting a high deductible health plan, she would have reduced her tax liability by $6,300. Now that a high deductible health plan has been established, this paves the way for additional tax savings in the form of a health savings account. Employers can contribute up to the maximum amount to an employee's HSA, or an employee and employer can combine contributions up to the maximum amount. All contributions are tax deductible. Now we are looking at a combined tax deduction of $9,500. The next step is to start a safe harbor 401k plan. Safe harbor 401k plans work best for companies that have a minority of high-income earners that consistently contribute to their retirement plans, while the majority of the staff members earn much less money and contribute less often to the company's retirement plan. Having a safe harbor plan enables the company to pass the ERISA requirements for top-heavy testing and discrimination against lower-income earners. As long as the employer contributes at least 3.5% of each employee's salary to the plan, they should be able to meet ERISA requirements. With these 3 plans, the owner is now looking at $12,500 in tax deductions. Professional overhead expense insurance is something that every small business with 3 owners or less should have. It covers fixed costs, employee salaries, insurance premiums, and outstanding loans. With the addition of the P.O.E insurance, the owner is now at $16,500 in tax reductions. She has covered the expenses of her business in case of an injury or a serious illness requiring an extended leave of absence. Her employees now have health insurance, and the company has a retirement plan. As wonderful as P.O.E insurance is, it does not replace the salary of the owner. This is why having a disability policy is a must for any business owner. Under IRS Section 162, a business owner may purchase disability insurance and deduct the premiums. For owners of S corporations, the premiums must be included on their W-2 forms as income. With the inclusion of a disability plan, we have now eliminated approximately $20,000 in tax liability. More importantly, the owner has provided key benefits to her employees and protected her practice in case of an injury or prolonged illness. You may have noticed that the owner's contribution was not included in the 401k earlier. This was done for two reasons. First, having P.O.E. and disability insurance should be a higher priority because when a business owner becomes disabled, employees will rarely sit around waiting to get paid. Also, with P.O.E. and disability insurance, the owner can continue to run her practice and receive income while disabled. Now for the owner's retirement plan. As of 2013, business owners can contribute up to 100% of their income, up to $51,000 per year, to a 401k retirement plan. Our suggestion is that the owner's contributions to her retirement plan be divided between the Safe Harbor account and an Index Universal Life Insurance policy. At 6% interest, the estimated return on contributions made to the 401k after 30 years is $419,343. The cash accumulation in the IUL is estimated to be $581,949 at age 65, assuming the current return of interest at 7%. The most important number on this list, however, is the estimated annual amount of $91,849 available to the owner from the age of 65 until the age of 100 from the Index Universal Life policy. This amount can be achieved by selecting the Lifetime Income Benefit Rider option. For more information on the products mentioned in this slide and how to reduce your company's annual tax liability, give us a call at area code 310-631-1106. And remember, you can pay yourself or you can pay the IRS.